Welcome to the Authority Hub podcast. I'm Nolan, joined as always by Claire.
And today we're featuring the expertise of Chris Genova, mortgage broker in Grey Bruce Region, Ontario.
Here's the situation. You've run your own business for 5 years. Your accountant has done everything right, your taxes are clean, and the bank just told you that on paper, you don't make enough to buy a house you can clearly afford.
That is the self-employed mortgage problem in one sentence, and it is not a rare edge case in Grey Bruce.
It's basically the defining challenge for a huge portion of the working population in this region.
Trades, agriculture, tourism, retail. A lot of the people who want to buy or refinance a home in Grey Bruce are running their own operations.
And the mortgage system was largely built around salaried employment, which means self-employed borrowers are constantly trying to fit their income into a framework that wasn't designed for them.
Chris Genova works specifically with self-employed clients across the Grey Bruce region, and the question he hears most often from those clients is some version of this. My accountant has kept my taxes low. Does that mean I can't get a mortgage?
And the honest answer is that it's not a yes or no question, it's a routing question.
Right, and understanding why requires understanding how lenders actually read a self-employed file.
Let's start there, because this is where the system failure happens for so many borrowers.
A salaried employee hands over AT4 and the math is straightforward, income is income.
A self-employed borrower hands over tax returns, and the number the lender uses is line 15,000 of the T1 General. Total income after all deductions have been applied.
So if a business owner has legitimately written off vehicle expenses, home office costs, equipment, professional fees, all of that reduces the line 15,000 number.
Which is exactly what those deductions are supposed to do for tax purposes.
But that same reduction is what the lender sees when they're calculating whether you qualify for the mortgage.
So the business can be genuinely healthy, cash flow can be strong, and the tax return can still show an income figure that doesn't support the mortgage amount being requested.
And that gap, between what the business actually generates and what the tax return reports, is where most self-employed mortgage applications run into trouble.
Chris Genova describes this as a routing problem, not a dead end, and that framing matters.
It matters because the instinct for a lot of borrowers is to walk away from the process when the first lender says no.
But a declined application at one lender doesn't mean the file doesn't work. It might mean it went to the wrong lender with the wrong income calculation.
And submitting to the wrong lender isn't just a rejection, it's a hard inquiry on the credit file and a record of a declined deal that the next lender will see.
Which is exactly why Chris Genova runs the numbers before any application goes anywhere.
That documentation review is the first step, not an application, not a credit pull, just a clear look at what the file actually shows.
For a self-employed borrower, that typically means the two most recent T1 Generals, the notices of assessment confirming those returns were filed and accepted, and for incorporated business owners, corporate financial statements.
Some lenders also want recent business bank statements to confirm that revenue is ongoing, not just what was reported historically.
And the standard documentation baseline is 2 years of NOAs and T1 Generals, required by virtually every lender in Canada.
The question is what those documents show, and what options exist when they show less than what's needed.
Let's talk about a scenario that comes up constantly for Chris Genova's clients in the Grey Bruce region.
A business owner has been operating for several years, the business is profitable, the NOAs are clean, filed on time, no balances owing.
But the 2-year average of line 15,000 comes in well below what's needed to support the mortgage amount they're looking for.
That is one of the most common starting points for self-employed mortgages in this market, and Chris Genova is clear that it's rarely a dead end.
There are a few directions worth exploring from that position.
Some lenders, primarily B lenders and alternative lenders, will consider a stated income or bank statement approach, where the qualifying income is derived from a reasonable estimate of gross business revenue rather than the reported net.
Those products typically require a larger down payment, and the pricing reflects the additional flexibility the lender is extending.
Another approach is looking at whether certain non-cash deductions, depreciation, for example, can be added back when calculating self-employed income.
Not all lenders calculate self-employed income the same way, and the difference between lenders on that point can meaningfully change what the qualifying number looks like.
This is where having access to multiple lender categories, A lenders, B lenders, credit unions, alternative lenders, matters practically, not just theoretically.
Chris Genova's approach is to match the file to the lender based on what the documentation actually shows, not what the borrower hopes it shows.
And that distinction is the whole job for a broker working with self-employed clients.
Let's talk about CRA complications, because that's another area where borrowers often assume the worst.
A CRA balance owing does not automatically end a self-employed mortgage application, but it does require a clear plan before the file goes to a lender.
Most lenders want confirmation that there are no outstanding CRA balances, or, if one exists, that a formal payment arrangement is in place and payments are current.
An undisclosed or unresolved CRA balance discovered during underwriting is a much harder problem than one that's disclosed and documented from the start.
Late filings are a separate issue. If one of the two required NOAs is missing because a return was filed late or not yet assessed, the documentation package is incomplete.
Some lenders will wait for the assessment to come through. Others won't proceed until both years are on file.
The practical implication is that timing matters, and a borrower who is mid-application waiting on a late NOA may need to pause the process or explore bridge options.
Chris Genova works through these complications with clients before anything goes to a lender, so the strategy is based on the actual file, not an optimistic version of it.
Now, the Grey Bruce region has some specific characteristics that make self-employed mortgages here different from what you'd encounter in an urban market.
Property values are meaningfully lower than in the GTA, which changes the math on down payment requirements and the access thresholds for certain lender categories.
Rural and agricultural properties also carry specific lender considerations. Not all lenders will finance properties with significant acreage, outbuildings, or mixed residential and commercial use.
A self-employed borrower who also operates a farm or a workshop on the same property needs a lender who is comfortable with that profile, and not all are.
And the local economy in Grey Bruce produces income patterns that don't always fit standard lender templates: seasonal businesses, construction, tourism, landscaping.
A 2-year average smooths some of that variation, but a lender unfamiliar with the regional economy might read seasonal income as instability rather than normal business rhythm.
Chris Genova knows which lenders are comfortable with Grey Bruce rural properties, which ones understand seasonal income patterns, and which ones have the flexibility to work with self-employed documentation that doesn't fit a clean template.
That knowledge comes from doing this work in this specific market. It's not something you get from a generic lender checklist.
Let's talk about what a mortgage-ready file actually looks like, because this is where the planning conversation pays off.
The core of a mortgage-ready file for a self-employed borrower includes filed and assessed T1 generals, NOAs with no outstanding balances, business and personal bank statements showing consistent revenue, and for incorporated borrowers, corporate financial statements prepared by a CPA.
But beyond the documents themselves, the file needs to tell a coherent story.
If income fluctuated significantly between year 1 and year 2, there should be an explanation: a contract that ended, a business expansion that required upfront costs, a one-time event that affected revenue.
Lenders aren't looking for perfection. They're looking for patterns they can understand and underwrite.
And for self-employed clients who aren't quite ready today, the planning conversation with Chris Genova is still worth having.
Understanding what the file needs to look like in 12 or 24 months, and what steps move it in that direction, is exactly the kind of work that makes the eventual application straightforward rather than complicated.
A well-prepared file can also meaningfully shorten underwriting timelines, because incomplete documentation is one of the most common causes of delays on self-employed files.
Here's what this looks like when it comes together.
A business owner in Grey Bruce comes to Chris Genova with a file that looks problematic on the surface: modest reported income, a question about a CRA balance, seasonal revenue patterns that look irregular to an unfamiliar lender.
Chris Genova reviews the documentation, identifies which lender's income calculation method produces a qualifying result, addresses the CRA question with a documented payment arrangement, and submits to the right lender the first time.
The client closes on the property.
The income that looked like a barrier on paper stops being a barrier, because the right lender was matched to the right file.
That's what a local broker who understands self-employed income structures in this specific market actually delivers.
The broader truth here is that self-employed borrowers in Grey Bruce are not edge cases. They are a large share of the working population, and the mortgage system's default settings were not built for them.
Having a broker who starts from genuine local knowledge rather than a generic checklist is what makes the difference between a routing problem and a dead end.
Chris Genova is a mortgage broker in Grey Bruce region, Ontario, specializing in self-employed mortgages.